That I'm going to mention in this video today are ones that new investors usually feel pressured to do when the market goes down. And let me just say, if you are not a long-term new investor, then just get off this video. So with all that out of the way, let's get to the topic of today's video. Today we'll be going over the 3 mistakes that I have observed that newer investors make. I'll also be describing what you should be doing instead. We'll also be going over all of my quote-unquote mistakes that I've made in my investment journey about over a year and a half now. And guys, if you are new here, make sure you subscribe and turn on the post notification bell. I upload every Saturday at 3 o'clock Eastern, and I think my content is super valuable for dividend long-term investors. As I said, smash the like button, subscribe and turn on post notifications. Roll the intro.
Hello, I like money.
The first of 3 mistakes that newer investors make is to sell a stock when it goes down. If you are conflicted to sell a stock, make sure you guys go check out my video that I published a few weeks ago of when you should sell a stock that is made for long-term investors. It basically goes over the scenarios where I think selling is appropriate. But when a stock dips on some stupid short-term volatility or bad news, you should always buy more. That is, only if you believe in the company long-term or are super confident in its management and future. Not only are you probably going to lose a high-quality position, you're going to lose capital gains, and you're going to lose dividends received for most likely years to come if you are a long-term investor. So yeah, absolutely do not sell on short-term impact. In the stock world, we call these type of people paper hands. You want to have diamond hands like me and the other 30 people that are subscribed to the channel. I can't say that I've made a mistake with this because all the positions that I've sold in my investing journey so far, I've just reallocated the money into higher quality companies in my opinion. To see what I'm selling every month, make sure to check out the portfolio updates, which you will be alerted to if you subscribe and turn on post notifications, wink wink. The second mistake that most newer investors make is to buying companies that are trendy or you don't do full research on. A couple of stocks that I could think off the top of my head are stocks like, Tattooed Chef, Palantir, and other companies like those. AKA anything on Wall Street bets. Typically, starting off, you're going to want to stay away from those companies because they can easily cause long-term bad habits in you. And yes, I am guilty of this. I did invest in only $60 worth, but $60 could have been put somewhere else, into Tattooed Chef. I've lost quite a bit of money on that so far, I can't lie, but I'm holding it for the long term in hopes because I am actually a pretty big fan of their product, and I think there's a big future for them ahead. And yes, I willingly do admit that this is a big gamble with my money, but considering it's only $60 for me, and the stock does have good potential to go really high in the long term, and I am investing long term, I'm just going to pull a diamond hands and hold on to it for a little bit. Also, not fully understanding or researching the companies that you invest in can be detrimental too. You can do this easily by just going on like Seeking Alpha or Nasdaq.com and looking at some of the statistics for the stocks you're looking at. The third mistake that newer investors make is YOLOing all their money into one position. Even if you have one really good company you think, you always want to diversify your money. As we learned in 2020, you cannot predict the future whatsoever. For example, we'll use our good friend John. John invested all of his money into Nike because he's a sneakerhead, and he thinks that they're going to be the best shoe company, which is definitely not a bad thought for the next 10 years. Issue is, Nike the next day announces that they're going to be retiring from making shoes and only doing clothing apparel. John's whole portfolio went 33% down that day. So that's definitely that's an example of over diversifying your portfolio. Typically want to have your max position be 10% in your portfolio in weight. I am not guilty of this habit, fortunately. And guys, the last one that I'm going to throw in for you, this is a little bonus for you guys for smashing that like button, which is chasing yield. I'm kind of guilty of this with AT&T. They had, I guess, kind of now, but they haven't officially cut it. They had a really high dividend yield. But I know that I don't think it's like the most severe case. I know people are chasing yields that are like 10+%, and they're just horrible companies they're investing in. Those are it for my mistakes. Make sure you guys smash the like button, subscribe. Make sure to join the Discord link in bio. Again, I upload every Saturday, 3 o'clock Eastern. Have a great day. Don't do drugs, do dividend stocks, and happy Halloween.